Welcome to the Explainer. So, if you're an accountancy student gearing up for the LECPA, you already know that the taxation portion can feel literally like trying to memorize a dictionary. But we are absolutely not doing that today. Instead, we're building a mental blueprint. My goal here is to help you encode these core concepts into your long-term memory. We want this information to stick, whether you're taking your exam in 2 months or 3 years from now. So you want to completely bulletproof your VAT knowledge? We are abandoning the stuffy textbook reading approach right here, right now. Instead, we're going to reverse engineer exactly how examiners test the value-added tax, and we are going to focus heavily on the massive updates brought by the Ease of Paying Taxes Act, or EOPTA. We're breaking this all down into digestible, highly visual mental flashcards that perfectly match how your brain actually retains information. Here's a quick look at our roadmap. 1. Philippine VAT DNA. 2. The tax credit formula. 3. Course of trade or business. 4. The importation exception. 5. The EOPTA accrual shift. And 6. A LEAPA survival review. All right, Section 1. Philippine VAT DNA, building the foundation. Okay, let's dive right into this. Before we can even think about calculating anything, we have to deeply understand the unique legal characteristics of this tax. It's a national tax, an ad valorem tax, meaning it's based on the monetary value, and a transactional tax. But for your exams, I want you to laser focus on 2 of these in particular. First, it's an indirect tax. This means tax shifting occurs. The statutory incidence, like the person actually filing that 2550Q return with the BIR, is the seller. But the economic impact, the actual financial burden, that's completely shifted to the buyer. Just by existing and buying things, you are paying this tax. Second, it's a proportional tax. It totally doesn't matter if you're buying a 100 peso meal or a million peso car, the rate is a flat, proportional 12%. Moving into Section 2, the tax credit formula, the mechanism. Now that we have the DNA down, we need to understand the engine that actually drives it. How is this 12% computed by a business in the real world? It's all based on the elegance of the tax credit method. It's a super simple 3-step flow. Step 1, when a business makes a sale, they collect output tax from the buyer. Step 2, when that same business buys inventory or supplies, they pay input tax to their suppliers. Step 3, at the end of the quarter, they simply subtract their input tax from their output tax. The difference is the net VAT payable that they remit to the BIR. Just burn this into your mind. Output minus input equals payable. Which brings us to Section 3, course of trade or business, the trigger. But wait a second, we can't just tax every single exchange of money in the country, right? There is a very specific trigger required to bring a domestic transaction into the VAT system. And that trigger is the phrase, in the course of trade or business, or CTB. For a local sale to be VATable, it absolutely must involve the regular conduct or pursuit of commercial activity. It has to be habitual. For instance, if you decide to sell your personal laptop to a friend on a whim, that's just an isolated transaction. You aren't in the regular business of selling electronics, so 0 VAT. However, examiners love, and I mean love, to test the boundaries of this specific rule. And here is a major LECPA trap alert. The law specifically states that regular conduct includes transactions that are incidental thereto. What does that actually mean? Let's say a manufacturing company, one that is purely in the business of selling shoes, decides to sell one of its old delivery vans. Selling vans is an isolated transaction for them, right? Because they aren't a car dealership. But because that van was used in their main business, the sale is considered incidental to their primary operations. Therefore, the sale of that single, isolated delivery van is fully subject to VAT. Do not let that isolated transaction trap catch you slipping on exam day.
Next up, Section 4, the importation exception, the trapdoor.
So we've established that domestic sales generally need to be in the regular course of business to be taxed. But there is a massive exception, a literal trapdoor in the tax code. Let's use some active recall here. Take a mental pause. If you buy a personal item from abroad, say a sick pair of sneakers for yourself, and import it, it obviously has nothing to do with any trade or business. Does the 12% VAT still apply? Lock in your answer. The answer is an absolute yes. Importation of goods completely bypasses the course of trade or business rule. It is subject to VAT whether you're importing it to sell in your store or just keeping it for personal use in your bedroom.
But here is the critical distinction you absolutely must memorize. While you always have to pay the VAT upon importation, you can only claim it as a creditable input tax later if the importation was actually for business purposes. Personal imports pay the tax, but they get absolutely no credit.
All right, Section 5, the EOPTA accrual shift, the renovation. Now let's see how this all builds into the newest, most heavily tested update in Philippine taxation, the Ease of Paying Taxes Act, or EOPTA. This completely renovated how we handle the sale of services. I need you to take a mental snapshot of this concept, because EOPTA is going to be everywhere on your exams for the next few years. Prior to EOPTA, the sale of services was taxed on a cash basis, using gross receipts. Basically, you only owed VAT when the client actually paid you. But under EOPTA, the term gross receipts is gone, vanished. It's been replaced by gross sales for both goods and services. Everything is shifted to the accrual basis. This means VAT liability is recognized the very moment the transaction is billed or consummated, completely regardless of when the cash actually changes hands. So the crucial takeaway is this. Under current rules, an obligation to pay is all it takes to trigger the VAT liability for a service provider. Absolutely no collection is required. If a problem on your exam says 75% of the sales are normally on account, guess what? That is purely a distractor. Because under the accrual basis, whether it's an account receivable or cash received, as long as the service was rendered and billed, that 12% VAT applies immediately.
Finally, Section 6, LECPA Survival Review, Mental Flashcards.
All right, we have covered some serious ground today. Let's transition into our final wrap-up to really encode all of this into your long-term memory. Here are your ultimate study hacks, your mental flashcards. Whenever you see a VAT question, I want you to run this quick diagnostic. 1. Watch out for the incidental trap. The sale of a company asset, even if isolated, is taxable. 2. The import exception. If it crosses the border into the Philippines, it's subject to VAT, business or not. And 3. The EOPTA shift. Say goodbye to cash basis for services. If it's billed or consummated, it is subject to VAT right then and there. Before we wrap up, I want to leave you with a provocative thought to really test your new mental blueprint. Imagine a nonprofit organization imports a vehicle entirely for charity work. A year later, they decide to sell that exact same vehicle locally. Based on literally everything we just discussed, which specific VAT rules trigger at the importation stage and which rules trigger at the domestic sales stage? Try to combine the importation rule, the nonprofit status, and the incidental trap. If you can work through that logic, you'll prove that you aren't just memorizing facts, you're truly understanding the mechanics of Philippine taxation. Keep building those mental models and good luck with your studies.